Are you ready to uncover the real forces behind market movements? Understanding candlesticks is just the first step. Now we'll decode how buyer urgency, seller desperation, and market psychology impact the markets. Think of the market as a bustling marketplace, with buyers and sellers haggling over prices. It's not just the number of buyers or sellers that matter, but their urgency to trade. In this world, perception is reality. The perceived value of a commodity can drive its price more than its inherent worth. Imagine a scenario where a rare artifact is up for sale. If potential buyers perceive its value to be high, they'll bid higher, driving up the price. Conversely, if sellers are desperate to offload a stockpile of goods, they may lower their prices, causing the market value to drop. Market dynamics are, in essence, the collective behavior of these buyers and sellers. Now that you understand candlesticks, you're one step closer to taking your first trade. But first, we need to reshape your understanding of the market and how price movements truly work. The number of buyers or sellers isn't the primary driver of price movements. It's their urgency to enter or exit positions. So who are these participants, and how do their behaviors influence the market dynamics? First, let's talk about the bulls. The bulls are optimistic market participants who believe that prices will rise. They enter the market with a sense of urgency to buy, hoping to sell later at a higher price. Their buying pressure can have a significant impact on the market, driving prices upwards. Next, we have the bears. These are the pessimists who believe that prices will fall. They sell with urgency, hoping to buy back at lower prices. Their selling pressure can push prices down. Then there are the hogs. Hogs are traders who hold on to their positions for too long, often driven by greed. They can affect market dynamics when they suddenly realize their mistake and scramble to exit their positions, causing abrupt price movements. And lastly, we have the sheep. These are the followers who jump on the bandwagon without much thought or analysis. They buy when everyone else is buying and sell when everyone else is selling. Their herd behavior can amplify trends, but it can also lead to market bubbles and crashes. These different market participants, with their varying degrees of optimism, pessimism, greed, and fear, create a complex web of interactions that drive market dynamics. They constantly assess and reassess the market's current situation, adjusting their positions based on their perceptions and expectations. But remember, it's not just about the number of buyers and sellers, but the intensity of their actions that truly moves the market. A sudden surge of buying pressure from the bulls, a rush of selling by the bears, a frantic exit by the hogs, or a stampede by the sheep can all cause dramatic shifts in market prices. Both buyers and sellers adjust their positions based on their assessments of the market's current situation. And this, in essence, is the heartbeat of the market, a perpetual dance of buying and selling, driven by the ever-changing moods and behaviors of its participants. Both buyers and sellers adjust their positions based on their assessments of the market's current situation. In the grand theater of the financial markets, every participant plays a role in shaping the narrative. The pursuit of market value is a never-ending chase, a dance of numbers and intuition. It's an intriguing game of chess where buyers and sellers, driven by their assessments, make moves that ripple through the market, influencing price movements. Imagine a typical day in the market. Buyers, fueled by optimism or perhaps a hint of greed, are on the hunt for assets they believe are undervalued. They're looking to buy low, with hopes of selling high later. On the flip side, sellers, motivated by a mix of caution and fear, offload assets they think are overpriced. They aim to sell high, intending to buy back lower. This dynamic interplay between buyers and sellers is the heartbeat of the market. Their collective actions, their pursuit of perceived value, is what sets the rhythm of price movements. But remember, the market is a complex system. It doesn't always dance to the tune of logic and reason. Sometimes it sways to the rhythm of emotion and sentiment. A sudden shift in market sentiment can make prices swing wildly, leaving traders scrambling to adjust their positions. This is where the pursuit of market value becomes truly fascinating. When the market takes an unexpected turn, traders caught on the wrong side of the move scramble to adjust their positions. A buyer, who was hoping for prices to rise, might find themselves in a position where the market is plummeting. The seller, who was betting on prices to fall, might suddenly be facing a soaring market. In these moments of chaos and confusion, the market reveals its true character. It's a wild beast, unpredictable and powerful. And yet within this chaos there lies opportunity. The most lucrative profit opportunities arise when traders are trapped in unfavorable positions and try to bail out. As the saying goes, one man's loss is another man's gain. Stay tuned as we delve deeper into understanding these market traps and how to spot potentially profitable opportunities. The most lucrative profit opportunities arise when traders are trapped in unfavorable positions and try to bail out. Let's dive deeper into this. Imagine you're on a sinking ship and you don't have a lifeboat. Your only focus is to survive, and you'll do whatever it takes to get to safety. This is exactly the situation traders find themselves in when they're trapped in a losing trade. Their primary goal becomes damage control. They're desperate to exit their position, often leading to hasty decisions that can have far-reaching effects on the market. Now, what do these market traps look like, you ask? Well, there are two main types. The first is a bull trap, which happens when the price of an asset rises significantly, luring in optimistic buyers. However, the price quickly reverses and falls, trapping the buyers who'd hoped for a continued uptrend. The second is a bear trap, which is the exact opposite. Here, prices fall significantly, attracting sellers who expect the downtrend to continue. But the market quickly reverses and prices rise, trapping the sellers who'd anticipated a consistent decline. So how do these traps present trading opportunities? When traders are caught in these traps, they scramble to exit their positions. Buyers caught in a bull trap start selling off their assets, and sellers caught in a bear trap start buying to cover their positions. This sudden surge in buying or selling activity can lead to significant price movements, providing opportunities for savvy traders to profit. The key to capitalizing on these opportunities lies in the ability to spot potential traps before they spring. This requires a thorough understanding of market dynamics, a keen eye for detail, and a healthy dose of patience. It's not about predicting the future, but rather about identifying patterns and trends that could indicate a potential trap. Remember, in the world of trading, knowledge is power. The more you understand about market dynamics, the better equipped you'll be to navigate the tumultuous seas of the financial markets and find profitable trading opportunities. Spotting these traders provides valuable insights into potential market reversals or significant price movements. Spotting these traders provides valuable insights into potential market reversals or significant price movements. This is where the magic happens, where your understanding of market dynamics transforms into actionable trading strategies. Think of it this way. Imagine you're a surfer. The ocean is your market, and the waves are the price movements. As a surfer, you don't just jump onto any wave, right? You study the ocean, understand its rhythm, and then pick the best wave to ride. That's precisely what we're doing here with market dynamics. Now let's consider a scenario. You observe a sudden rush of buying activity. Prices are going up and it seems like the market is on a bullish run. But wait, don't just jump in yet. Remember the principles of market dynamics. Is this buying activity a result of genuine buyer interest? Or is it a trap set by sellers looking to offload their positions? By understanding the dynamics at play, you can better interpret these situations. If you notice signs of seller desperation or buyer urgency, it might indicate a potential market reversal. This is your cue to prepare for a change in market direction. On the other hand, if you spot signs of a strong trend with consistent buyer or seller interest, it could indicate that the trend is likely to continue. This could be your signal to ride the wave and capitalize on the trend. The key here is to stay vigilant, patient, and always base your decisions on a careful analysis of market dynamics. It's not about predicting the market, it's about understanding it and making informed decisions. Remember, the market is like a giant puzzle, and understanding its dynamics is like having the picture on the puzzle box. It guides you in placing the pieces together. So keep refining your understanding, stay disciplined, and apply these insights judiciously. You'll find that you're not only reacting to the market, but also anticipating its movements, setting yourself up for lucrative opportunities. Now that you understand these market dynamics, you're better equipped to anticipate market movements and find lucrative opportunities. Don't forget to like and subscribe for more insights.